The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
And welcome to The Trade. Before we get into the technicals, let's have a quick look at what traders are watching today. The US Treasury Department seeing soft demand for a $16 billion sale of 20-year bonds. Investors very much worried about the country's increasing debt burden and spending bill that is expected to worsen the fiscal outlook. Canada's finance minister says he would raise the importance of the country's deep trading relationship with the US in a discussion with US Treasury Secretary Scott Bessent. Meanwhile, finance leaders from the Group of Seven democracies seeking to downplay disputes over President Trump's tariffs and try and find some common ground. The Japanese finance minister saying he didn't directly discuss his country's holdings of US Treasuries during his bilateral meeting with Treasury Secretary Bessent. Let's get across the technical. Zoran Kresovic from Blueberry Markets joining me now. Good to see you, Zoran. Look, what are we looking at in terms? What are we looking at in terms of where we're seeing the ASX 200? We are on a bit of a retreat today, but not getting back to those highs we saw a little while ago.
Absolutely, yes. Bit of a retreat actually from the morning open and overnight session in the US. But nevertheless, it looks like actually, some of the ground that's been actually lost is actually predominantly coming back, and it looks like majority of the sectors are actually, buying into the market or at these levels. And I know many will actually disagree with me on this. Obviously the guest that you just had previously speaking about the grossly, overvalued valuations on the stocks, which I actually tend to agree on, and there's all this macroeconomic risk as well as the policy risk that's actually coming out of the US. But looking at the chart in itself and being a technical guy and predominantly focusing on the sentiment right now, it does look like we actually got a bit of a V-neck recovery in terms of the actual ASX 200, which seems to be providing quite a bit of cluster and resistance around that $8,300 level. Obviously, the uptrend line from the lows on 7th of April is actually providing quite a bit of a cluster and trend-based hugging at the moment. And I'd like to actually see this continue to actually march a little bit higher, because from those levels back in 7th of April, we actually seeing the market retrace somewhat off at 17.5%. So whilst we're not there at an all-time high, we are in a range-bound trading right now. So we are back in a zone of 8,100 to 8,500. The range zone has actually provided quite a bit of cluster in the past, if focusing back in 2024 and 25. So I'm still looking for more signals probably from the RBA, especially given the RBA's decision on Tuesday. If we are likely to get further interest rate cuts from Australia, then hopefully they will actually provide a bit more sentiment for ASX 200 to continue running and testing their all-time high.
Absolutely. And the other thing that sometimes gives us a similar reprieve as a rate cut is lower oil prices. I mean, you had that spike around this time yesterday on those concerns about Israel hitting Iranian nuclear facilities, but oil dipped again overnight. What are the technicals showing you?
So technicals haven't changed much for the past few days. Obviously, we are still in a downtrending channel, as we can actually see back from early 2025. So demand, supply, and all the geopolitical risks are actually driving all the headlines when it actually comes to the crude oil in particular, because of obviously the trade tariffs that we had earlier in the year, and obviously the supply and disruption chains that are probably likely to continue over the next few months. I think the interesting thing with crude oil is obviously OPEC product supply and demand issues that are going on. Obviously, we are actually seeing quite a lot of crude oil actually getting disposed within the market in itself. So there is actually a lot of that. Last night, crude oil inventories rose by 2.5 million barrels in the US for the week ending on 16th of May as well, in comparison with a build of 4.3 million barrel reported by API for the week prior. and we were expecting something of around a decline of 1.9 million barrels. So it looks like actually there is quite a bit of supply in the market right now. We are still within the range zone at the moment. We are still consolidating on crude oil. I would like to see the levels broken around $65, $66. I think if we can actually continue that slight uptrend from the May lows, then we are likely to probably go into the range and break their major resistance level around $67. If not, if obviously crude oil this was only a pure counter move to the downside, and we were likely to actually see Treasury yields actually get sold off more and US dollar continue to head lower. And if we don't find a long-term resolution with regards to the trade war, obviously 90 days is actually coming up, quite quickly. And then that could potentially add further disruptions in the global supply on crude oil, or in demand, if I should say it that way, and basically add a level of concern that could see crude oil continue to head lower. Anything below $55 would provide a major trough level, and we would actually probably prevail a long-term downtrend, which has been actually happening since around March 2022. So likely the long-term trend would actually continue to go further down, which could add major concerns around global growth and macroeconomic outlook for the rest of the world.
All right, and the British pound, 3-year high.
Pound is probably one of my favorite charts at the moment, Julia, purely on the basis that obviously it's hitting a major resistance level around 134 right now. Whilst they actually didn't manage to break and have a clear run-up post UK CPI data that came out last night, which actually came both on the headline front as well as the core mean higher than what market anticipated, adding further issues and challenges around the Bank of England interest rate cut and monetary policy stance when it comes to the actual global, or I should say UK growth. So, the chart itself is actually quite healthy. It's been looking fairly robust and bullish. The lows in 2025 up until now prevail and continue that strong uptrend. We've also got a falling flag pattern in a rising market, which is generally considered as a consolidation, and strong moves would actually prevail and continue out of those range trades, which is exactly what happened. So whilst the move actually was quite significant last night, we might actually see some delays from the Bank of England in terms of the interest rate cuts. That heavy resistance level of 134 was not actually able to hold, and it looks like we might actually have to retest it again. If we do break that level, then we are likely to actually head higher towards that 135, 136 level. We've also got the US dollar, which is actually weakening quite significantly. And if you have a look at the US dollar index since around January 2025 in regulation from Donald Trump, it's actually come off 10% or so. So if that trend was to continue, then obviously pound with strong economy and inflation figures, strong consumption growth, as well as the labour market, we're likely to actually see delays in the interest rate cuts, which would actually provide headwinds for the pound to continue actually heading higher up.
All right, Zoran, thank you. As always, Zoran Kresovic, Blueberry Markets with us. That does it for this edition of The Trade. Be sure to join us next time.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.